Warm welcome all of you to Finance Academy Roundtable. So, in this series of the Roundtable, we have discussed on the various topics. Means, let's say, the way we have started within a broader market, thereafter the future and options, thereafter the real estate, and today we are starting on a very interesting topic that is in personal finance. Frankly saying, that means I am a student of commerce, and while studying the commerce, we have studied everything. That means economics and accountings, economics at a country level, at an international level, accounting for a very big companies, and planning, budgeting, understanding the cash flows of a very big companies. But we have never understand the economies of our own. That means we are as a person also, we have our own economies, we have own budgeting and planning kinds of things, but we haven't realized that kinds of things. I think on this note, everyone will be agree with me that means this kind of education should come in a very earlier part of our career, maybe the part of our educations in a college or in a school about the personal finance. But जब से जगे तब से सवेरा. So uh, never of the late, but today we are going to understand about the personal finance. And why the personal finance is that while taking the sessions on the stock market as well about the direct investing, I used to encounter one question कि market में कितना पैसा डालना चाहिए. So it is not a very rocket science that I am having X amount of money in my fund which is laying at a 3% and market has in projections near over by the 12%. So we just uh, means close our saving account and put the money into the market. It doesn't happen in that way. There are certain kind of the calculations that we have to go through. Means about our emergency, about our contingency plans, about our some sorts of other commitments are there that we need to follow. So these are the things that we have to walk through. Fine, and thereafter we can understand that this is the amount which is my risk capital, so I can put it into the market. So today with the Rakesh, means I am very delighted to introduce Rakesh today. The first of all, they are our own great. They have learned about the stock market from a Finland Academy, and they are had a very diverse amount of experience. We can say means experience in a field of personal finance as well as data and information security profession. They are also a military veteran. They have worked with a very well-known businesses house like PwC and Flipkart. So today, I warm welcome to Rakesh ji to share your insights on financial planning and take us through that. What are the basic things that we need to understand? First of all, very much thank you so much, Rakesh ji, for accepting our request and overing to you to convey us about the financial planning. And how we are going to do this session is that first of all, we will understand Rakesh's content or flow, that what they have to say. And in a later part of the sessions, we will be having the Q&A sessions. So Rakesh, over to you.
Yeah. Thank you, Kapil. Good morning, everyone, and thank you for joining us today. I hope that this session will be of some use to you. Before I start, I'd like to tell you that I normally conduct these sessions over a period of around 6 hours, 3 to 4 sessions of 1.5 to 2 hours each. In the interest of time today, I will try and cover as much as I can. I might go a bit fast, and we will give about 45 minutes for questions and answers, so that any doubts which come up, you can, clarify it before we leave this call, right? So with that, I'll get started, and I hope you get to take away some learnings from this session. So what I plan to do is to cover it in a few sections. If you actually see, there are a lot many. I hope to at least cover the first 5, and if possible, the 6th one also, right? I know most of you are very interested in the investment avenues. So if we run short of time, I'll skip some of the sections and go to that one, right? All right. So first thing, when you start off with financial planning, right? Why do you need financial planning? The entire purpose is that we all want to have a decent standard of life, right? But the income or our sources of income are limited. Expenses can be unlimited, right? Depending on our needs and our wants. But to be able to fulfill our goals in life, the financial goals at least, right? Money can only help you to some extent, the rest is up to us. We need to have a strong base of our finances. All right. So first step is not investing, it's not savings, it is having a budget. It is understanding where your money is going out. What is the income you're having in? What is going out? Where is it going? And how much do you have left? And if you see, a lot of people nowadays do not have budgets. In the time of our parents, our grandparents, they had family budgets, right? Income was tight. The budgeting was done properly. So a large number of people in a family and limited income. So they used to plan it out so that everything is met, right? Nowadays, we do not do it. Most of us don't do it. I used to not do it till a few years back, right? What I suggest is always have a budget before you start anything, at least for 3 to 6 months at the least. You should understand where your income is coming, where it's going. If you do not know that, it is going to be difficult for you to do anything beyond it, right? I personally use these two applications. Walnut is a mobile app. Perfios is a cloud software. I'm not recommending anything, but these are the two software which I use. And I find them extremely useful for my requirement. There's adequate analytics without being overwhelming. And Walnut being on the mobile, it can detect and read your SMS transactions. Perfios, you can link it to your accounts, banks, mutual funds, insurance, whatnot. And it gives you the option to stay updated, right? So not a recommendation, but this is what I personally use. All right. And the budgeting is the most important. It's a starting point of a journey. If you do not budget, the rest of it is going to collapse. I can assure you of that, right? You will realize it with time yourself. The next important step is actually protection, right? What do we mean by protection? So when we say protection, we are talking of protecting both our assets as also our lifestyle, right? In the unfortunate event, but of our not being around, right? It's just a matter of time. It's going to happen with everyone. We want to ensure that those left behind do not have to grieve in addition to our loss of lifestyle or loss of assets. I'm aware of many cases where people had home loans, but had not taken either home loan insurance or term life insurance, which was adequate to cover the home loan. And their families, in addition to losing the individual, have also lost the home, right? So, which is why insurance is a very important part of your what do you call financial journey. Unfortunately, in India, thanks to LIC, thanks to our wonderful agents, they mostly push ULIPs, right? Money back policies, child plans, endowment plans. These may be good for the insurance companies and for agents. And I'm not saying all agents are bad. My father has also done worked as an LIC agent after retiring, right? But the point is that not all agents are scrupulous enough to push what is in your interest, right? They generally end up selling you what suits them or what suits their company, which is why it's very important that when you're going in for policies, it is preferable to go for term life plan, right? Because term life plans are pure insurance plans. They do not have any return of investment with them, right? So if you see this term life plans, these are what are the good policies. They're pure term life. If you are not around, they pay out a money. If you survive, in my point of view, survival is good enough, right? I do not want anything back from my insurance policy. In addition to that, you need to have, depending on your personal circumstances, these particular policies, right? Health insurance. Everyone has realized it after COVID, right? The requirement of health insurance. I myself have realized that I do not have adequate insurance, right? So health is extremely important. Depending on your requirements or your job or personal, you might need accident insurance, house insurance, if you're staying on rent, contents of the house, right? So insurance is essential. Please do not overlook it. If you do not have adequate insurance, get that in place first. The next step for protection is an emergency fund. What is an emergency fund going to do? It helps us with a cushion. That's all it is. It is a cushion. I do not want returns from an emergency fund, whether it's 0 or 1% or 2%. I'm fine. I'm not looking at returns from there. If you have a stable income or you have a job security, 3 months should be adequate. If you're self-employed freelancer, your job security is not assured, like COVID, a lot of people have lost their jobs. You can then accordingly plan 12 to 24 months of expenses. When we say expenses, it's expenses which can be on a monthly basis, quarterly basis, it can be income which is on an annual basis, or income which is, sorry, I've been saying income, it's actually expenses which are on a lump sum basis also, right? So the aim here is that we are not looking at returns, but we need liquidity availability. And please, after insurance, build up your emergency fund first before investing, before doing anything else. Because if you do not have an emergency fund, you will end up withdrawing from your investments for emergency situations. It could be a family emergency, it could be health emergency, right? It could be an accident. You need to help out a family member or a friend. Anything can be an emergency as per what you perceive it to be, right? So before anything, budget, put your insurance in place, emergency fund. If you do these three things, I would say you're ahead of 90% of the population. All right. You can skip the rest. You can drop off from the session right now, and you're still 90% ahead of 90% of the population. All right. I may sound facetious saying that, but that's a fact. All right. Now, once you have actually done your budgeting, you know what is your expenditure, what is your income, you have to now start saving, right? I know it'll seem like, why is he talking of silly, basic things like savings? But trust me, a lot of people do not even reach this stage, right? Unlike earlier generations, savings do not come naturally to the current generations which we are part of. Now, this is generally what people do with their savings, right? We perceive it as our income minus our expenses. Whatever is left is our savings. This is what most of us do. This is what I did till a few years back. It was only after exposure to people, to reading books, reading blogs, that I actually switched my view around. And I have now come to what should be the actual thing, which is our expenses should be what is left over from our income after we have done our savings, right? It should not be the other way around. This is how it should be. Your income minus savings is what should be expenses. Remember, because savings is actually laying down the foundation for us, right? So please try and inculcate this mindset. It will help you quite a bit, right? We need to get out of this one, right? So basically what we're doing is that we're paying ourselves first by saving before spending. And this is where budgeting comes in, because if you do not have a budget which you stick to, you are not going to be able to meet this equation, because your expenses will always overrun your income. Leave alone leaving anything for saving, you'll realize you're at the end of the month in debt, right? And what we need to remember is savings is not investing. Savings is separate from investing. I'll clear it later. This point I've added because I've realized a lot of people are not in the habit of clearing their credit card bill in full, right? Please clear it in full, because even a single rupee which is left over, if you only pay a minimum amount due, every rupee left over from the day that amount is there is being charged a whopping interest of 3 to 3.5% per month, right? So what you're earning in a year on your saving bank account, you're paying in a month to your credit card by issuer, right? So if you think of it that way, where what you earn over 12 months, you're paying in 1 month, I'm sure you know what to do, right? Coming to investing. Now, if I said from your budgeting was a start point, saving was laying the foundation for your financial independence, then you can liken investing to actually going and building your home, right? I've just tried to simplify it into 3 steps: budget, save, invest, right? And in between, I've thrown protection, right? So if you do these 4 things, I mean, you're set, right? Now it's just semantics and nitty-gritties where you actually go invest, how you go invest. If you just reach the stage of investing, you've started a journey. It will generally end well, unless you go and make silly mistakes, which is not part of our conversation today, right? Now, many people think in terms of investing as get rich quick. It's not, right? If you do not have savings, there's going to be no investment. Now, what do you mean by savings and what do you mean by investment? Most of us think they're the same. They have a lot of similarities. They got to do with saving your money, right? But your investment is you're actually trying to growing your savings. Saving is a retaining portion of your income, right? Investing is growing those savings over time. And where the differences come in is savings, I'm concerned with accessibility. I'm concerned with being liquid, right? Investing, these are not the important one. The risk, return, and time horizon are important, right? Savings, I might need to access it 3 months down the line, 6 months down the line, a month down the line, right? I'm putting in mutual SI fund, SIPs, so I need money going into them. So, which is happening monthly, right? So the period is that much, so I need savings. Now my investments could be 5 years, 10 years, 20, 30 years, right? So I'm not concerned as much as with the accessibility or liquidity. I'm more concerned with the risk and the return on those investments, right? Now, please be aware, I'm giving a very high level view. I want to just push all into this, right? But not drown you with excessive information. I've kept it very simple, very high level, and I'm mostly talking on this. We have a question answer session of about 45 minutes. So at that point of time, you can ask me your questions. Right now, coming to the meat of the discussion for today, which is actually financial planning. Again, we'll just cover a high level overview, right? Dip our toes in, titillate you, get you excited, interested in the topic, but not leave you so overburdened that you don't come back to it at all, right? I wouldn't want that happening. So, why do we do financial planning? How do we do it, right? And what is financial planning? Right? You need to know what you are doing it for. You need to have some goals. Those goals need a time frame, and they need an associated figure. As on today, let's say you want to cater for your child's education 10 years down the line, right? Today's budget for that is 10 lakh. So you have a figure of 10 lakh, you have a budget, a time period of 10 lakh. And now you know that 10 years down the line, education has an average of 10% inflation in cost every year. 10 years down the line, right, it is going to have more than double. It would be approximately around 24, 25 lakhs. If you just take that inflation of 10% in education cost. So you know that 10 years down the line, you need approximately 25 lakh. You can then use time value of money, work it out backwards, and get a monthly investment amount. 25 lakhs might look big if you're starting from zero, but when you actually break it down to a monthly investment, it can come as less as 14 to 15,000, depending on what your avenue of investment is, right? So first thing, if you do not have an emergency fund, you will not be able to do anything, right? So I've already spoken about this. I've again put it here in red, and it might seem corny key again and again. I'm hammering on the same thing. Trust me, I have weathered many situations, and while myself being under financial stress, being able to help others solely because of this, right? If you take one thing away from this entire 2-hour session, one thing, emergency fund. You can ignore everything. You can leave everything. There's one, just this one point will give you peace of mind, will allow you to sleep well, will cater for a lot of requirements. So I'm again and again and again harping on emergency fund. If you want to take a second point away and you want to leave it at 2, insurance, right? Ignore everything else, forget everything else, do these 2. All right. So what do we do in a financial plan, right? It's nice and nifty to talk of financial plan and all that, right? So what we actually do when we talk of a financial plan is you need to have a written financial plan. I have a lot of wonderful ideas, and I've written, I think about 10, 20 books in my head, but on paper, there's nothing, right? So if you do not write your financial plan down, it's not a plan. You're not going to implement it. You won't remember it a year down the line. At least I don't remember my plans a year down the line, right? I'm lucky if I remember it for a week. Right? Again, like I mentioned, protection, insurance. Have your insurance in place, have your emergency fund. The rest is all blah, blah after that, right? And the last thing which we all want to do, we want to retire. And that is why your financial planning is essential. If you do not have your plan, you will face a situation which you have seen many people are in, where their life outlasts their finances or their savings, right? Because what is happening is you're talking in terms of time periods of 30 years, 40 years, 50 years. Suppose, say, a person who's 40 is looking to retire at 60, that is 20 years. And suppose he lives till 90, So you're talking of 20 more years of earning, investing, and then running down that corpus for 30 years. You're talking of a half a century. If you do not have a plan, I can guarantee you, unless you have an extremely large corpus and you're highly disciplined, you will land up in a soup, right? So there are also certain other things where financial planning will help you know where you stand, you know where you need to be. Let's think of it as a roadmap, right? If I want to go from Bangalore to some place, if I don't know where my destination is, I mean, how do I get there? As simple as that, but we don't realize it, right? So I need to have a destination. Let's say I'm going from Bombay to Pune. There are multiple routes I can take. So which is the route I'm going to take? Right? What is the avenue of my travel? Am I going to fly? Am I going to take a train? Am I going to drive? Am I going to hire a taxi, go on a motorcycle? Maybe I just want to cycle up and I'm adventurous enough to walk it out, right? Which is like using saving bank account for your financial plan. So you need to have a roadmap, right? This is where your financial planning comes, where you are starting from, where you want to end, how you plan to get there. Yep. So I'm breaking it down into, giving you analogies which are easy to understand. It's not a complex topic, though. As a financial planner, as a financial advisor, it suits me to make it complex, right? Others, you will go do it yourself. What's my purpose? What's my use? All right. It also involves things like managing your taxes, managing your cash, which are not the focus of it, right? So let's jump in and let me try in what time we have to cover it as much as possible. All right. So like I said, we are assessing our current position. We are looking at our future requirements. We've already spoken about how goals are part of it. And the whole planning of these two aspects is your financial planning. That is it. Where you are, where you want to be, how you're going to get there, right? Simple. It actually is that simple. And the rest of it is what? Executing it, monitoring it on a regular basis. And as and when required, you reassess, rebalance to stick to your plan, right? Let's say I take a wrong turn or I take a detour. I'll not continue on the wrong turn, right? Let's say I turn off towards Goa because I feel good about Goa, but I need to get to Pune. So just because I've accidentally taken a turn towards Goa and I realize, oh, this is going to Goa, my plan is Pune. I'm not going to continue to Goa. I will come back to Pune, right? And that is what is required. So that is where your rebalancing, reassessment comes in. All right. A lot of us focus on the execution of our plan, monitoring it on a day-to-day basis. I would say execution monitoring maybe about 10 to 20% of your actual financial planning. 50 to 60% would be the first steps, your plan itself, the planning process, right? Focus on the plan. The rest will take care of itself. And another important part which nobody thinks of, doesn't have it as part of the plan, leave alone doing it, is the last portion of rebalancing, reassessment. People treat it like if you remember the Hero Honda ads, fill it, shut it, forget it. That's what people do with their investments. There are about 2 lakh crores rupees of investments which are lying with banks, companies, mutual funds, insurance, FDs, post offices, because people have passed away. Their family does not know where the money is, what the money is, or the people themselves have forgotten. I have people in my own family who are in that situation, and I keep trying to help them, my friends, colleagues, with this thing, right? So if you do not know where you are, you do not know what you have, you're not going to be able to do anything. Please keep your family informed. This is not a thing to hide, right? If you do not have discussions, if you're shy, if you're chary about discussing your finances with your family, there is no point of saving, because when we are no longer around, they will not have access to a fund. Then what is the whole point of it, right? Now, see, we spoke of, the stepping stone, a foundation, building a house. Same thing, different options which you can use. Like this is a pyramidal structure. You start off with protection, your insurances, right? Emergency fund, then, and you have your savings. Then you have your investment, which is shown here as growth and diversification, right? Once you met your investment goals, you have surplus amount beyond that. Feel free to go into speculation like commodities, futures options, Forex, share trading, cryptocurrency, right? There's no end to it. Going for portfolio management, alternate investments, right? And at the top, when we are on our way out from this life, we need to have a succession planning, estate planning, that's having your will, right? Sorting out your documents, sorting out your, I don't want to leave 10 properties to people to sort out the mess. My personal view is have one house to stay in. Everything else is an easy to manage things. We'll come to that later, right? So I'll be sharing this deck with all of you later. You can go through this in detail at that point of time. Just understand, this is your planning process. You start at one level, right? You then have to move to the next one, the next one, the next one. Do not try to reach here without having first set the rest, right? That's your house is going to collapse. Unfortunately, currently, especially a lot of people start off with these things, right? Forex, futures, options, before they actually have built up their savings, investment, insurance. Don't do that. The long way is harder, but let me assure you that is also more stable and it is more rewarding, right? Now, when I actually take these sessions, right, till what we have covered is itself by something covered in about 2 hours. All right. So we go through things in detail. We harp on things. I hammer away at my pet peeves, essentially bore people. And then we come to the actual process of financial planning. Now, not everyone is interested in financial planning. Not everyone needs to do it, right? And not everyone wants to spend time doing it. So because of which I've just got a very simplified sort of process, which everyone and anyone can do it, right? And in fact, I would say everyone should do these steps at the least. We have already spoken about your credit card bills. Please pay them in full at the end of the month, right? In fact, try and pay them 3 to 5 days before. And remember, credit card is not a solution that expenses are overshooting our income. So we use credit card. Think of it more as an alternative emergency fund. I use my credit cards as an emergency fund. I use it all from all my regular expenses, but I make sure that is within the amount I can pay off when the bill is due, right? All your EMIs, keep your EMI to the minimum, pay it off at the earliest. If you can, save about 20% of your post-tax income, I think you're on your way, right? You're far ahead of most of us. Aim for 50% and you're set, right? I wanted to actually include a chart which shows you, depending on your saving rate, how much your, what do you call, your time to financial independence is. I'll add it in the slide before I share it with you, but do remember, the higher your savings rate, the better your, what do you call, financial journey will be, right? In addition to that, try and maximize your tax advantage investments, not a focus. Do not purchase or invest because of the tax, right? That is ancillary. Okay. Now, again, when you're starting off on a journey, when you're building your base, right, don't get into trading, right? Don't get into high fee, actively managed avenues. Build your base with low cost index mutual funds, right? Large cap funds. Slowly move up the risk chain, right? So if you're able to do these 4 things, pay off your debt, invest, save and invest on a monthly basis, right? Try to reduce your taxes legally. I'm not telling avoid your taxes, but there are legally available avenues for reducing your taxes. Make use of them. All right. And if you try reducing your cost, reducing your loss of capital by not trading, this itself will help you to a very large extent, right? Now, not everyone gets happy with a very simple, just 4-step. What's the whole hullabaloo about investing and financial planning and saving? If you can reduce it to 4 steps, there is nothing. This is it, right? You can add on a lot of glamour, glitter to it, but end of the day, this is what you need to do. First 2 steps, right? Last 2, add on icing on the cake, you're set. I understand not everyone wants to even do this. You have SEBI registered investment advisors in India who are supposed to act as a advisor to you in a fiduciary capacity, right? Which means is they are duty bound to do what is in your interest, not what is in their interest. right? A registered investment advisor or a financial advisor from who's registered by with SEBI is different from everyone else. All of us who are mutual fund investors, distributors, insurance agents, brokers, guys like me just advising people for free, right? The financial advisor is duty bound to suggest and recommend what is in your interest. All right. And they also help you prepare a financial plan. It can be a simple one, it can be a detailed one, it can be a step by step one, and they can handhold you in your entire financial journey. So depending on what your relationship, you engage with them. Just remember, they're called as registered investment advisors. There is a website called FreeFinCal. I put the link at the end of the deck. You can go there. They have a link of a list of reliable financial advisors in India. You go to LinkedIn, you go to SEBI website, you can find everything. Search engines are your friend, use them freely. Right? Now, for those whose appetite hasn't been vetted by the simple process, I can give you a detailed one, right? I'll just run through it. I will not go in depth within this, right? So how do you go about it? We have spoken about creating your financial roadmap, right? Which is used where you are, where you want to be, how you want to get there, and all of that, which we just spoke of, right? See where your comfort zone is in terms of risk. What is your risk mindset, right? I feel I'm a high risk taking investor, but when it actually comes to my execution, I'm actually not. I'm more of a medium to high risk, right? But in my mind, I am a high risk investor, but I'm not. And the earlier one accepts where we stand, the better it is. Okay. Then you need to have an appropriate mix of investments, which we'll again cover later, to see where what will help you reach your goals. Right? You need to have adequate diversity, maintain, create an emergency fund, pay off your high interest debt. If you see, a lot of things keep coming up again and again and again, because that is it. It's a very simple thing. It's a basic thing which all of us can actually do if you are interested, if you put your mind to it, right? And if you are an investor without a large corpus, then for us, what we need to do is we need to consider something like rupee cost averaging, right? You invest in shares, small amounts, but every month, disciplined manner, right? Or you use mutual fund SIPs. You're investing in mutual fund through the systematic investment plan. A mutual fund SIP is not a product, right? A lot of people get confused. The product is mutual fund. Systematic investment plan or SIP is a way of putting it in. Consider it as akin to a recurring deposit. Every month you put a fixed sum into the fixed deposit, right? So mutual fund SIP is same. Stick to your asset allocation. Have your asset allocation. Stick to it, right? Do your portfolio rebalancing. I mean, some of these points will get covered if we have time. So, like I mentioned, it's a high-level view I'm giving you. What I generally cover about in 6 hours, I'm trying to cover in an hour to hour and a half, right? Again, tax benefits, we have spoken of taking advantage of them. And I've also told you about avoiding circumstances that lead to fraud, right? You don't want to lose your hard-earned savings, right? So it's not easy to spot a fraud, but it's not that difficult if you train yourself. All right. So since I've been able to rush through all this, I can also spend some time talking about how you plan what are the considerations? How do you literally go about doing your planning? All right. I'm not going to stop to take questions right now. Please hold your questions till the last 45 minutes when we will take all questions that we can, right? So when you're planning, everyone's needs, requirements, wants are different. Like for me, books are what I spend money on, right? Family. Rest of the things I'm not really concerned about. There are others for whom travel and vacations are primary, right? I have a friend whose only requirement in life is actually all she wants to do is help people, right? So her wants, her needs are very limited, and she uses her considerable income just to help others, right? So each of us is different. We have different start points, different goals, and we need to tailor our plan to our requirements, right? Inflation, think of it as a negative interest. It is there persistent, it is there all the time, and it is out of sight, out of mind, but it is there day on day, year on year, and it's eating into your returns, right? Do not only think in terms of the return on your investment, consider the associated risk, right? And then you need to also see how you're going to actually invest. What are the avenues or the tools you're going to use to do this? All right. So let's just quickly see what is inflation, right? It's nothing but the increase in cost. Now, if you see a fuel prices, right? I remember fuel prices when I started actually working. I remember prices of around $18, right? So you know how old I am. 18 rupees used to be what petrol used to cost for a liter. As on date, it is past 100, right? Diesel is crossed 100. Diesel is to be in the low 10, $11, right? It's crossed 100. So this, the march of cost is what interests us. The annual, daily, monthly increase in cost of everything, food, fuel, because it's a good topic. Everyone's upset about the cost. That's why I brought it up. But anything and everything, the cost increases over time, right? So you think of it as negative interest because it is eating into everything you have or you will have, right? If you keep inflation in mind, a lot of things get what do you call adjusted later. Now, what we focus on is the return, right? But what you should actually focus on is something called as a real rate of return. What is a real rate of return? It is your return minus inflation. This is what you are actually getting, not what the advertised interest or the advertised return is, which is why bank accounts, FDs are not great options, right? So central banks like our RBI is constantly trying to balance between inflation and growth. You don't want, outrun inflation at the cost of outrun growth, right? Or reverse, great growth, but high inflation. You want a balance, right? But not always easy to achieve. So I'm not going into this. This is actually how interest and inflation works. You can go through it later. If you have any questions, please feel free to reach out to me, right? Another concept is the time value of money. The longer I'm investing in something, the more the uncertainty, all right? And the more I need to be compensated for that time period also. So that is where this concept of time value of money comes. If I'm giving you money for a year, it's less risky, right? I can somewhat predict what's going to happen after a year. I don't know what's going to happen in 50 years. So for that uncertainty, I need to be compensated. So that is a concept called time value of money. I've simplified it quite a bit. It's not as simple, but just remember that time also has a monetary value, right? And you will have all seen this. The longer your FD, the higher your interest rate. If you go in for a 1 month FD and you go in for a 5-year FD, you'll see that the interest rate is very different. After a point, you'll also see it either flattens out or tapers off. Open any paper which has FD rates, you'll see this for yourself. And that is the time value of money, right? Now the next is risk, right? What is risk? Risk is, again, you face uncertainty. If I'm going to give money to the government of India, I'm reasonably sure that I'll get my money back. If I'm going to give my money to the state, Indian state government, right? Whether it's Maharashtra or Nagaland or wherever, I'm reasonably, again, assured I'll get my money back, but I'm less certain than I'm compared to government of India, right? I come to State Bank of India. I trust State Bank. Though I don't use State Bank of India, I trust it more than I would trust my private banks, which I actually use. But right, because I know it's implicitly backed by the government. If it goes to PSUs again, so there's a sliding chain, right, of where I trust, and where the uncertainty is more. Right? So where the uncertainty is more, I need more return because the risk is higher. So that is why it's always you will see risk and reward being associated, and you always have your spectrum: low risk to high risk, high return to low return. Right. So if your risk is low, your return will be guaranteed to be low. Risk is high, your return also has to be, or rather your expected or potential return should be high to cater for that much risk. Because if a high risk and a low risk investment gives me the same return, I'll always choose a low risk investment. All right. Now, I actually cover this later, But given the paucity of time, and I know that most people are more interested in this topic, I've moved it up uh, ahead of the other aspects which we have just overseen till now. Sorry. So we have actually spoken of a few of these while talking. So what do you have? You have cash. You can put money in your blanket or your mattress. You can have it in wallets. You can have it in your bank account, right? You can have it in fixed deposits. These are all cash, right? Liquid revenue funds. All these are basically cash equivalents, money market instruments. The next thing you have is debt and bonds. So this is, let's say you take a NCD from a bank company, or you take a fixed deposit with a company, right? Or you're investing, you're giving government certain options of FD at a post office. These are all debt. And similarly, bonds are also a related concept where you are non-convertible debentures, you're taking preferential shares, a lot of different aspects you're bundling up, where the aim is to get a steady income, right? Which is generally stable. That is the aim with the first two options. Equity, you all know, you're investing in the shares of a company, and you're getting growth in terms of the annual capital appreciation if the markets are going up. Negative return, market goes down, and hopefully some dividend in between. Mutual funds are basically a vehicle which you can use to invest in any and all of the above options, right? Insurance, you all know, the only insurance you need to actually use, term life insurance. Avoid any and all other life insurance. General insurance, depending on your circumstances, requirements, accordingly, you need to have them, right? Small savings schemes are government schemes, Provident Fund, National Savings Schemes, Senior Citizens Saving, Samyukta, sorry, so I'm forgetting that for the girl child. So all of those are the small savings schemes. Now, in addition, many of us use gold, you use real estate, use jewelry, silver as investment avenues. So those are also legitimate avenues of investment. How you go about it is your personal choice. I'll also try and cover those. Right. Now, before we go to some of those topics, a lot of you would have actually seen, somebody would have shown you a beautiful chart like this, and many of us would have then gone and invested in equity, because you see that is a zooming away, everything else is somewhere at the bottom, right? So if I'm trying to sell you an equity product, this is what I will show you as a chart, right? How many of you have seen a chart like this? What you're seeing here, this is equity, right? You're taking all the risk, you're taking everything. But bonds invested with the government of India, right? And your equity is almost there. This is as on March last year, when the what do you call the markets had dropped, right? So nobody is going to show you this if I'm going to sell you equity. But if you see at this point of time, your equity returns over something like 25 years was just about 11 odd %, right? Your return on bonds was also about 10.5%. Gold was giving you a return of about 9.5%. Right? So you can see the difference between this chart. Again, we're talking of bonds, FDs, gold, equity. You see the difference. So I will, statistics can be manipulated to show you what I want to show you. Right? Statistics is only believable if you know the context and the background to it. Right? So depending on what I want to sell you, I can show you the appropriate chart. So please be aware, this is how things work when somebody is trying to sell you something. All right. Now, same concept, I'm explaining in a different way. Right. Here we are talking of, again, 1 week. Right. I'm talking of 1 year. Again, 3 years, 5 years. Both the chart is similar. Over here. Sorry, I'm just having a bad throat. Right. So this is 1 week, 1 year, 3 year, 5 year, same with the chart below. But here, if you see the 1-year return is showing you as 27%. Here, the 1-year return is showing you as 5.5%. Right. So what is the difference? Why 5.5 over here? Why 27% over here? We're talking of 1-year return itself. Right. Same assets, equity, gold, cash, fixed income. So again, depending on what I wanted to buy, I can show you the appropriate chart. The only difference is the point of time when I've captured it. One is in March 2013 when I wanted to show you a wonderful return. Now, if I want to show you wonderful returns, I'd capture the period only from March 23rd, 2020 to October 2021. Right? It'll show a wonderful straight line up. All right, but I won't show you from Feb because I don't want to capture that 45 days of drop. Right. So please be aware of these things, nuances, when a distributor, agent, or a financial advisor, or someone like me comes and shows you beautiful charts to try and convince you. Try and understand what is the data, what is the time period, what is the horizon, what is the risk and the reward behind those charts. Equity only works long term, right? A lot of people will tell you long term is 5 years. I don't want to say they're wrong, but they are wrong. 5 years is not adequately long term, right? When you're planning for 50 years, 5 years is not long term. Long term has to be at least a 10-year plan. If you're investing in equity, if you're investing in international funds, please think in terms of 10 years plus as your investment horizon, right? Because if you see, there are deep drawdowns, right? Here, this is last year. You don't only look at the jump up, right? But if you look at a long enough period, you look at a 10-year period, right? So you get this. This is one 10-year period, right? This is another 10-year period. So if you see over time, it will do well. All right. But at any point of time, they can be dropped. This can be a 10-year period. But if I have just a 5-year horizon, all right, let's suppose I have a 5-year horizon and I've started somewhere at this point of time, right? Where does your 5 years end? Somewhere around here, right? If you have got out in this point, you have lost money, you have lost time. To here, there has been growth, right? But if you get out at this point of time, you have actually lost money, right? I'm making it a messy chart, but just remember, try and invest for the long term. It'll take care of our stupidities. It'll take care of market stupidities. It'll take care of government interventions. It'll take care of things beyond control of anyone, right? Force majeure and acts of God. Everything, solution is time. Right. Now, in trying to sort out, coming to mutual funds next, we had a whole hodgepodge kitchery of mutual funds, everyone defining them the way they wanted. So the Security Exchange Board of India said, okay, let's make it simpler for investors. Let's come out with a framework. So being the bureaucratic organization and country that we are, we have come out with this simplified structure of mutual funds for all of you, right? So they made it simple. Sorry, but I couldn't help this. This is your, there have been a few changes, but this is what a mutual fund, recall, universe is, right? These are all the different types of mutual funds. I've taken this from Value Research online website. I have a wonderful resource. I have been using them for close to about 18 years, right? And I subscribe to everything that they have. I don't use the subscribe features, but I want to support them. So I've taken all of it, right? So you broadly have equity, which is what everyone associates with mutual funds, but you also have sectoral funds and thematic funds, which are also mutual funds. Debt funds are your, like I said, cash equivalents, debt, bonds, those, and you have a hybrid, which is a mix of equity and debt. You also have commodity funds and, international funds, all of that fit in into this, right? Not going to go in depth here, far too many things. And if you're the type who likes more information, there is something just put out here. Again, like I said, search engines, everything is there online. Thanks to the information age, we have access to a lot of information. Difficulty is choosing what to read, right? So these are the nuanced differences. If you're interested, please go through it later. Right? Investment in fixed deposits, right? A favorite avenue. At least all my aunts, uncles used to like it. They're not so happy anymore, right? And why is that? Because especially last couple of years, if you see, interest is a red line, right? I would actually choose inflation as a red line. But your interest has been coming down, inflation has been going up, your real rate of return has been in the doldrums. Here, your return is what? -1%, right? -1.5%, because of this change, right? And this is when inflation is low. When inflation is high, your inflation is almost 7%, your interest is 4%. This is almost -3%, right? And we are talking of it before tax, before the government of India takes its cut. So you're losing 3%, and then the government of India comes and says, boss, where's my 30% cut? And you'll land up with a real rate of return of approximately -4%, right? I'm not using calculator. Back of my mind, I'm just shooting out these figures. And here we're talking of 2 years. You think, okay, the last 2 years have been bad, that's why. No. You look at it from a period of almost 20 years over here. This is a 20-year timeline, right? Your FD is the orange line, right? Your inflation is the green line, and blue is what you're actually getting as a return. Look at this time period. From sometime in 2007 to nearly 2011 beginning. Your real rate of return has bottomed out at -10%. You're paying 10% to hold an FD. Wonderful, right? But it's a fact. We have done it. You accept it, you don't accept it, numbers don't lie, facts don't lie. Right? Right now, again, as you see here, we are again in a stage where inflation is rising. Interest rates are actually bottomed out, staying here. You're again in negative return. All right? Leave this. Leave all this. Just inflation itself will reduce the value of your FD. Right? This is a FD of about, I've just taken a figure of 10,000 to make the chart. 10-year tenure, 9% interest, right? 8% inflation. So you're actually, I'm saying you're getting a real rate of return of 1%, which you're not getting. You're getting a real rate of -4. We are taking a utopian scenario, 1%. Still, just with tax, your FD is going down. This is, you invested 10,000, 10 years down the line, you're left with 8,500 in the money value of 10 years later. Not a situation you want to be in. Right? So what is an alternative? You have debt mutual funds, right? Which go from low risk, right? And they can be high risk. People think debt funds are only low risk. No, they can be high risk. They can be very high risk. Anyone who's invested in Franklin Templeton 6 of their debt funds, you would have realized your money was stuck for 2 years in something which is called as a low risk ultra short fund, right? A low risk short term fund, and your money was stuck for 2 years. You couldn't take it out even if you wanted to, or you needed to. I know people who had almost 80% of the savings there because they said low risk, high return, and they were stuck for 2 years. It's as bad as being stuck at the cooperative bank, which is collapsed, and your money is there. You can't even take it out for your daily expenses, right? So it's not risk free, right? And this is slightly outdated for the Indian scenario because we have changed certain nomenclatures. MIP no longer is there, but just understand that there is low risk, there is high risk, even in debt funds. And this is an option when you can come. And why debt funds are better than FDs is solely because of the taxation difference. On your FD, you're supposed to pay interest every time you're supposed to pay tax every time the interest is paid out. Debt funds, you only pay out your tax when you withdraw the money and on the gains you have made, if any. If you hold a debt fund for 3 years, the taxation you get, indexation benefit, I can't cover all of the details here, but your tax outgo reduces greatly, and you have only paid tax once at the end of 3 years, whereas your FD, if you have got interest annually, you paid tax 3 times. So there's less amount left for compound growth, right? Now, I'm running short of time, so I'll just quickly cover a few of these topics, which some people have always asked me, right? That's it. You're just given 2-3 things and you're running off. What about our favorite things, which for many of us is real estate? Uh, I am of the personal view real estate should be for living, not for investing. There are better options for investing in real estate. I'm not saying don't invest, but don't buy a property as an investment. You're stuck at one flat or one shop, right? In one building, in one locality, in one corner of one city or one state or one country, right? When you look at it that way, you're essentially going to be in a bad position if there's an earthquake or a flood or any number of scenarios, right? Your neighboring building collapses onto your building. What are you going to do? So keep that mindset. Do not use real estate for investment. I will sound cocky and arrogant saying this. It's a stupid way of investing. A lot of you will disagree. You're free to disagree. My point of view, your point of view, we all right in our own place, right? Why am I saying this? Because you now have a better option to invest in real estates in India. These are called as real estate investment trusts, right? They are listed on the stock exchanges. They're professionally managed. You get geographical diversity, right? You get exposure to commercial real estate, hospitality, hospitals. You get to residential complexes, office complexes, warehouses, right? As an individual investor, you can't get exposure to all of these or uh, many of these unless you have a really huge corpus. But even then, you're stuck with certain things like high transaction costs, illiquidity. You can't dispose of, if you want, let's say, 10% of your real estate investment, you can't. You have to dispose of a whole house or a shop, right? I highly recommend, if you are using real estate for investment, get out of your old real estates, right? Your old way when you had no choice. We all have had real estate as investment because we had no choice. Now you have a choice. Change our mindset, get into these. There are 3 rights listed in India: Embassy, Mindspace, Brookfield. Between these 3, you are going to have investments in wonderful products: Bangalore, Chennai, Hyderabad, Pune, Bombay, Noida, Gurgaon, Delhi, Calcutta, right? And many other places also they have. You're going to get into some of the best hotels. You're going to be an owner. Some of the best uh, office complexes in India. Think of it that way. Get out, get into real estate investment trust. Rest is your choice, right? Some more things people want: gold. It's essentially meant as an hedge, right? It's not really an investment avenue, but it is a very good hedge, right? Against inflation, against market drop. Again, keep it to 5 to 10% of your portfolio. I keep telling people, if you're not wearing the jewelry, don't hold it as jewelry. You have sovereign bond funds where the government of India is guaranteeing it, plus giving you 2.5% interest on that, right? Uh, just give me 1 minute, please. I need to just connect my charger. Yeah. If you do not want to use sovereign gold bonds because these need a demat account, you can go in for gold ETFs, which are again listed on the stock exchange. Both of these need demat, right? The other option, you can put SIPs into gold mutual funds. All better, safer, easier, and more convenient, plus cheaper options than holding gold in a locker and or at home. All right. Commodities, again, many people like to use other things, other precious metals. They like to use copper, commodity funds. You can be using it for trading. You can do it, but if you understand the commodity cycles, right? Do not go into this blindly just because somebody tells you. Again, if you want exposure to commodity, don't want to understand, use mutual funds or portfolio management services which are focused on commodities. Many people also use foreign exchange. It's essentially, you can use it as a trading, because unless you have a huge foreign portfolio or exposure, you don't need it for hedging. I haven't covered it here for that reason. All right. So just because I don't want to answer this question, I've already mentioned cryptocurrencies here. My first question: why do you need it, and do you really need it? Right? If it excites you so much and you understand it and you're prepared for extreme volatility, right? Like losing 30% in one day. You go to sleep and morning, by the time you wake up, 30% vanish. Please go ahead, right? But again, please restrict it to 5% of a portfolio. It is a good thing, it keeps you with the in crowd. You can talk of it in parties. but unless you have a significant exposure, you understand the things that will not make a big difference to your portfolio, right? Now, the reason I'm calling this a rudimentary deep dive was because I know it's an oxymoron, and is because I don't have the time for this, right? We have covered things like asset allocation, portfolio management, risk, but we haven't spoken anything about these, and even the first three, we haven't gone in depth about it. I do not actually have the time for this, but let me just quickly run you through a few pictures, which is why instead of speaking, I thought I'll put this, right? I wanted you to understand this. Now, the red line is equity, the blue is debt, the green is gold. We have seen slides of this earlier. But what is the difference of seeing here, right? Something is doing well, same thing is doing badly, doing well, doing badly. Something else is doing middling, not bad, not good. And another thing is, okay, up, down, right? Just keep this picture in your mind. This is the Indian markets, same three assets, equity, gold, debt, right? And this is over a 30 period time horizon, right? Split into 5 years, 6 years. So, 5 years, sorry. 30 years split into 5 years gaps. So at one point of time, you had equity doing well, but at another point of time, you actually had equity giving you negative returns. You will see this 5 year and this 5 years, right? Equity is giving you negative return. All right, but at that point of time, you have had something else giving you positive returns. Here, gold is giving you negative returns. All right, so why am I showing you this? Why am I talking of the asset allocation? Right, because now we have from 3, you come to 6 assets. Again, you see all of them have different return graphs. Right, you go to 10 assets. No one asset is ever at the top. Right, 10 assets, 10 years. Right, you do not see any one asset coming at the top for more than 2 or 3 times. Again, no one asset is at the bottom for too long, right? You see a small cap has been at the top 3 times, but it has also been at the bottom 5 times. Gold has been at the top 2 times. It has been at the bottom 3 times. Previous one is Indian markets. This is US and international markets, right? So what I want you to understand is no one thing does well all the time, every time. All right, which brings us to the concept of asset allocation. Have a mix so that between different things over different points of time, you are generally stable. All right. So, which is why if you see 4 different charts, all the same concept. Have a mix. All right. Portfolio management, again, far too detailed a subject to cover today or now. You have to construct a portfolio, you have to manage a portfolio, monitor it, and rebalance. The last two should not take more of your time, which is where most people spend time in monitoring and rebalancing and managing. Construction should take more time. If we have future sessions, we'll cover this. Risk management, again, spoken of the risk reward already. Told you that you need to understand your risk. And then the last portion is actually managing your risk. I don't have time for this, but let me talk of risk assessment a bit, right? So what is a risk assessment is knowing your risk profile, your willingness to take risk, your ability to take risk. All right, like I spoke to you saying, I consider myself a high risk investor. I actually am not, right? And if you do not understand your risk profile, you cannot do your asset allocation properly. Okay, so that is, and based on what you have as a risk profile, I have actually a risk scoring, which you can use to evaluate where you are. Depending on the score, you can place yourself on the risk level from low risk to extremely high risk. Accordingly, choose your asset allocation. Fully in equities, which I never recommend. Fully in safe things, which I never recommend. Always be balanced somewhere in between. Right? Similar to what you saw earlier as your financial planning, what do you call a pyramid. You also have a risk return pyramid, right? Low risk, low return. High risk, high return. These are all things which keep coming up, future things, cryptocurrencies, and there's always new inventions in finance which are asking you for more risk, asking for more fees, and promising you higher returns. Please feel to fill ABC, whatever you want over here, right? But remember, the higher the risk, the higher the potential for return. Vice versa, higher the potential for return, the higher the risk of loss of your capital. All right. The last portion is how do you actually determine your investment corpus? You can do it by thumb rule, better than having no idea. You say, okay, I'm spending 10 lakh a year. I assume with inflation 20 years down the line, that will be about 20 lakh. And I need it for 30 years beyond that, blah, blah, blah. You get a round figure, 30 into 20 lakh, 6 crore, and you say that is not accurate. Better than not having a figure in your mind. What I would advise is a goal-based approach. You have goals, education for your first kid, second kid, your retirement, buying a car, buying a house, wedding, blah, 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 your wedding or your kid's wedding, right? And you have a goal, you have a time period, you have a figure for that, adjust inflation and get your corpus, which you require, that is more accurate, right? Goal-based. Always build a margin of safety into anything you do, and especially in your finances. If you find out that you require 10 lakh for something, I personally choose a 25 to 30% margin of safety. So instead of 10 lakh, I'll make it 12.5 lakh or 1.33, 13.3 lakhs, right? Adding in a margin of safety. The more important something is for me, the higher the margin of, higher the margin of safety I build in, right? And if something is short term, not very important, I don't even build in a margin of safety, but important goals, please do that, right? Last portion, which I want to tell you is you need to have an investment framework. Like I said, if you have an emergency fund, if you have your insurance, if you do savings, you are ahead of 90% of the people. You start investing, you're ahead of 95% of people. Once you do that, select the assets, have your goals, have your time horizon, and how you actually do it is going to be your investment framework. No time to discuss it here, unfortunately, really sorry for that, but I've at least given you a high level view, right? I hope that has been of some use. I've also included some resources which will help you. Any search engine, I prefer DuckDuckGo, is your friend, use it liberally, a lot of resources. What you have to be careful of is screening and filtering your information sources. Avoid the talking heads on TV. No, nothing good will come to you from that, except wasting your time and spoiling your eyes. All right, so I'm done. Kapil, how do you want to do the question answer session? I wanted to give about 45 minutes, and we have 47 minutes for the round table and the question answer.
Okay, fine. First of all, can you give me a check? Is my audio is fine?
Yes, Kapil, we can hear you.
Okay, fine. Yeah. So thank you so much, Rakesh, for this wonderful sessions. We can understand your time limitations. That means within the just 1 hour and 15 minutes, you have gone through a very important insights into the things that what are the essential things that we need to look at. Yes. So now without wasting too much time, we open for a Q&A sessions. So yes, means we take sessions from the participants so they can directly address your question to you. And I request Amit to give them an audio right for a while, so we can.
Yeah, Kapil.
Yeah. So whoever wants to ask a question, please choose the raise hand option at the bottom, and Amit will give you the audio right. So already there are a couple of questions. First from Subhajit. Subhajit, thanks for the question. When you think in terms of emergency fund, it is not percentage of income, it is number of months of income you want to cover. You want to cover it for 3 months, 6 months, 12 months. What your expenditure over the year divided by 12 is your monthly expenditure, and 3 months into that or 12 months into that, which is why you need to do budgeting so that you understand what the monthly expenditure is going to work out to be, right? I hope I've answered your question. I see Sitaraman has raised his hand. Amit, can you just give them the rights? Or you can also use a Q&A button to ask your questions, because I'm reading those also, and I'm answering them either over there or by speaking to you. Prashant Jha, thank you for your comment. I appreciate the same.
Okay.
Mr. Sitaraman, you can unmute yourself and ask your question. You have permission.
All right. So in the meantime, Vijay Saha has asked whether NPS should be part of our core portfolio. I will answer by saying there is no right answer to any question. It depends on your personal situation, right? Now, I have access to NPS in my job, but I do not use it because I like to be in control of my finances. NPS has restrictions where the investment is put in and is locked in for 60 years. It doesn't suit me. A large number of people, if you have access to NPS, my answer would be yes, it is something you should do, because it's better than having nothing, right? But does it suit you is something which you have to see. Does it meet your requirements? It's a very good vehicle, because you can have a mix of equity, debt. You can leave it automatically, they'll adjust it for you, and they will do it on their own for you. You don't have to do it. It's a tax efficient approach. Within your portfolio, they are rebalancing, right? So it is a good scheme. It's getting better with every year, and but it's not right for me. I don't choose it, but I advise it to a lot of people. All right, Nitin Kumar is asking, is financial planning? Yes, financial planning is dependent on your age, but more importantly, it is dependent on where you currently are, where you want to be, and how long you want to you have to reach that. Let's say I have a colleague who's 25 and who plans to retire by 35, right? I wish I was in his situation. So he's got actually 10 years and he wants to retire, right? And then do what he wants to do. So he has to have a very aggressive saving plan. All right, because his plan is 10 years. 35 he wants to retire, and another 55 years he needs his plan to save. He doesn't plan to stop working, but he plans to do things what he wants to do. So dependent on your age, but more importantly, dependent on your goal and where you want to be, how you want to reach there.
Yes.
All right. So another question Subhajit has said is, car is a necessity than a luxury. Okay, so what I think he means is that car, I'll read what he's written. He said car is sometimes a necessity rather than a luxury. What is the investment one should look for with automobile as cost of vehicle decreases with time and now fuel prices are increasing? So I think what he means is that cars are a depreciating asset, right? Over time, the value of your car, the day you drive it out from the showroom, it has reduced by 10 to 20% over the next 1 year. Right. So yes, car, it depends, right? So I know people, I love driving, but I wouldn't buy a car because I love driving. I'd rather take a good car, drive it for a couple of days, return it on from these rentals, right? Now, some people may want to drive it daily. So if you see it that way, plan for it, prepare for it, save for it, and definitely go ahead and buy it. I have a classmate of mine who did the same thing. He wanted a BMW, but he didn't go and buy it immediately. He saved for it over 5 years. Then he went and bought with a very small loan. And he has now held that BMW for 15 years, and he's been very happy with it. All right. It's given him a lot of pleasure. Would I do that? No. Should you do that? It's your choice.
Okay. Yes. We have one question from Romaldoji. They are mentioning that, please mention the asset allocation ratio, how to plan for.
Yeah, so asset allocation ratio, like I mentioned, it depends on what your financial plan is. It is not a standalone thing, right? So what is a risk profile? What is a time period? If let's say, okay, let's take the example of the car. I want to buy a car in 5 years. That, in my view, is a short to at most medium term, definitely not long term, right? People may say it's long term. I beg to differ. I would take it as medium to short term. I am not going to put into equities for that, right? So what is my goal? It's not a standalone. If my asset allocation depends on what my goal is, and what I choose for that goal depends on what my time frame is, what my fund requirement is. So I cannot say it in standalone key asset allocation ratio, right? It depends on many factors. So I have no straightforward answer to that, right? I know it won't satisfy the question, but that is how it is. So Dinesh Parab has asked, how can one identify his own risk-taking ability? There are a lot of tools available. You can just take a risk profile, risk questionnaire. There are a lot of them. I can also share some. And like I said, Google, any search engine is your friend. You will find these, right? A lot of mutual funds, a lot of insurance companies, they have this on their website itself. You don't have to really go searching somewhere. I'm not going to take answers related to very specific questions like, are equity saver funds better than balance funds? It depends. I can't give a straightforward answer, right? So I will avoid answering these, Praveen. Sorry for that. Okay, Naveen Senal asked a good question. What are the avenues that are relatively low risk but give returns that are higher than inflation? Again, there are no ABC answers, but yes, currently fixed deposits do not give. You can look at a few hybrid debt funds. You can look at conservative debt funds. These will at least match inflation, right? Currently, inflation is on a rise, but you are looking at it over a longer term period. So if you're looking only to beat inflation, I would say you need to have at least 20% equity in your portfolio, which over the long term will beat equity. You need to have some income generating assets, right? So you can have something like, let's say, another 20% to real estate investment trust, which will also give you regular quarterly income. And about 60% you want to keep it safe. I'm assuming I'm focusing on the low risk part, right? And you use conservative debt funds, you use conservative hybrid funds, you use ultra short funds, those sort of things. You go on the lower side of the risk spectrum. Joseph, what can be the best investment asset or gold? No answer there. It depends on your personal circumstances, your risk profile, your time horizon. So there is no right or wrong answer. It is only what is right or wrong for you. I know I'm giving very nebulous answers, but that is finances for you. It is very individual, right? What is right or wrong for me may not be right or wrong for you. Okay, Yatharth has got a question, doing BBA and want to do either CFA or CF planner. So see the difference between chartered financial, it's not advisor, it's actually analyst, CFA, chartered financial analyst, and chartered financial certified financial planner. The difference is the focus is different. If you become a CFP, you are looking to be a financial advisor, right? You're looking to maybe manage investments, manage funds, but primarily advise clients. If you're becoming a chartered financial analyst, you're looking more at what are the investments to buy for your company, right? So you are not going to deal directly with your clients or customers, but you're more on the research, analysis, and investment side of things.
Okay.
I hope that answers your question. I think he is not realized it. Okay, Subhojit has another question. With COVID hitting, rental market change for IT cities and companies trying to work from home. Subhojit, I frankly have no idea, and I frankly don't care because I'm using real estate investment trust. They are being paid to manage it, and they better do it well, or I'll take out my investment from there. Right? I think this is far beyond my level to comprehend, leave alone understanding, which is why I choose options like real estate investment trust. Bangalore collapses, Pune collapses. I'm sure all cities in India will not collapse at one point of time, which is why I have all the three real estate investment trusts in equal proportion. And I'm invested across the country, micro markets, macro markets, states, North India, East India, South India, West India, everywhere, right? So I'm covering myself by using professionals and geographical diversity.
Okay, fine. Yes, Rakesh, in your session, the very first thing or takeaway that you have said, that means about an emergency fund, and the next best thing that you have said about the insurance. So how one can determine that how much insurance is sufficient for me?
Right, Kapil. A very good question, which I actually didn't cover because I didn't want to get into the details over there. So in emergency fund is for right now, today, tomorrow for me to use, right? So you think of it in terms of months of expenses it can cover. 3 months, 6 months, 9 months, 12 months, maybe even 24 months, right? So that is a amount of money I want to have available as and when I require it for whatever point of time. Insurance is more long term. I am trying to make sure if I'm not around, my family's financial requirements at least are met. I'm not there for anything else, but I don't want them to be in financial trouble, right? So how do you work back? You need to understand what is your investment corpus. You need to know how much money you require for all your goals, right? You work back from there. So you work forward towards your financial planning, reach a corpus, your goals, your time horizon. Then you see, let's say you need 2 crores, right? You have half a crore.
Mm-hmm.
All right. So then you say, okay, I need 2 crores, and if I'm not around and I'm not able to contribute, I have 50 lakh today. I'll take a plan of 1.5 crore term life insurance.
Okay.
All right. That is how you work out your insurance. Again, very high level will not be the exact way you do it, but you work out your corpus, you see where you currently are, and your difference is your insurance. right? It should cover your monthly expenses, your annual expenses, any outstanding loan, car loan, home loans, right? All of that you add on to your corpus. So you say 2 crore corpus, half a crore home loan, 2.5 crore. You have half a crore left invested already. 2 crore then you need is your insurance, right? I hope that you clears it, Kapil.
Yes. So it is about backward integration that we need to do, and whatever the amount that I require for the future and whatever I am having right now, so that is the difference amount is the insurance that I should go for.
Exactly.
Okay.
And again, repetition multiple times, go in for term life insurance, avoid ULIPs, and those endowment funds, money back funds.
Any criteria that one should look for while choosing a term insurance?
Primarily, all are equally regulated under the Insurance Regulatory and Development Authority of India. The two factors to look for is what is their claim settlement ratio, right? You want to go for an insurance company which has a claim settlement ratio of 98, 99%, at least 97%, first criteria. Second criteria, what are the features and time horizon they offer? Not every company offers the same time period. If you need a 30-year insurance, or you need, let's say, a smaller figure for 30 years, look at those criteria, the features which offer. Third is the cost.
Okay.
Right? And preferably going for online term insurance plans, because the commission which the company would have paid to the agent, they pay you in terms of reduced cost.
Okay.
And take insurance as early as possible, because the younger you are, the cheaper it is. Older you get, the cost increases, plus you might have medical problems which they might ask you to pay a loading, which will increase your insurance cost.
We have one question from Naveen ji. They say that are balance funds right place to park a surplus fund? If yes, then what should be time horizon?
So I'm assuming surplus funds is funds which you have for a short-term horizon, and they are not a suggested revenue. If depending on whether you need the money in a month, 6 months, a year, look at liquid funds, ultra short-term funds, money market, overnight funds. Balance funds are fine if you have a time horizon of 5 years and plus, right? If you're looking at hybrid equity, aggressive hybrid funds, 7 to 10 years minimum time horizon. If you're looking at conservative hybrid funds, 5 to 10 year time horizon.
Okay. We have talked about the asset allocation as well. So let's say sometimes we feel a kind of incompetent to take a call that whether this is the right time to invest in a gold, or whether to reduce or trim some sort of exposure from the equity market and go for the yield. So is there any kind of mechanism that some authority or some products, they take a call behalf of us? That means where gold proportion has to be high, or where the equity proportion has to be high, or where the debt proportion has to be high. So we need not to take a call on the individual note.
Yeah, so a few of them we have discussed, like NPS does it for you, right? That's a national pension scheme. They do it automatically in some of their funds, because the fund manager takes that call. Balance funds, which are now called as hybrid funds, they take that call. Like let's say an aggressive hybrid fund will hold 65 to 100% in equity, depending on what they perceive. A conservative hybrid fund will take 0 to 20% in equity. Then there are multi-asset funds which have 3 assets in different ratios. Right. You also have ULIPs which do it within them for the balancing. You also have new products like equity saving fund, balance advantage funds. Right. In fact, the number of options are far too many. Portfolio management services do it for you. Alternate investments fund do it for you. So the options are far more and confusing than the requirements.
Okay. Right. So yes, so this is a kind of agencies which takes calls behalf of us. That means where to invest and how to take an exposure in the different ways.
Yeah, I would prefer to leave it to the professionals to do this for us. Unless you're a full-time investor or a full-time trader and you are aware of things, you are in the market, right? For most of us who have a job and investment is not the main focus of our life, I would recommend to stick to the professionals. Right, my suggested approach is pay a financial planner upfront. Like nobody likes to see cash going out, but I would recommend pay a financial planner upfront, get a plan made, and then choose investment options which you can do directly, right? So you can use many places to buy your mutual funds now, right? There is Coin by Zerodha, which will let you invest in mutual funds directly. I use mutual fund utilities, which charges you nothing, gives you access to all mutual funds. It's regulated by SEBI, AMFI, right? Very good platform. It can be used as a distributor, as an investor. There is a Mutual Fund Central, which is coming up, giving you options. There are a lot of apps, websites, which take a small amount and give you a platform to invest, right? There is far too many to even mention, and I don't want to take specific names, right? Except ones which I actually use.
Okay.
There's Small Case, which will allow you to invest in equities using SIPs, right?
Okay.
Zerodha lets you invest in equity through SIPs. So avenues are far too many, right? But knowing what to do is the problem. So pay a financial advisor who will tell you what to do. Go back to them yearly, right? And it's better than paying a distributor or a mutual fund or a commission or agent or a company. I would rather pay an investment advisor who is working for me upfront rather than paying somebody else who's working for themselves on a monthly, yearly basis, which I don't know about because that is all hidden in the cost, the commission, the cost.
Yes. You have talked about the small case finance. Small case means nowadays a lot of comparison is happening between the small case and mutual fund. So can you give us a little bit basic info about that? Means what the small case is all about, because it is a newly coined word, we can say.
Yeah, exactly. So I think what you mean is ICICI Prudential Mutual Fund and Small Case has tied up, right, for the ETFs to provide ETFs through them. All right. So first, I'll just quickly explain what a small case is. Small Case is a app, a website, a company, right? Smallcase.com. What they have done is, instead of you having, let's say, if I want to buy 10 companies, Reliance and all expensive shares, I may not have the amount of money available today to buy all of them together, right? So what Small Case allows me to do is let me make a briefcase or a portfolio or what they call a small case of shares, 10 shares, 20 shares, 50 shares. And I say, I want to be able to invest 10,000 every month into all of these. So they will take your 10,000. The requirement of those shares you have put is 1 lakh at any point of time to invest, right? But they, using the algorithm, structure it so that your 10,000 every month or every week or every fortnight is invested into a different certain proportion of shares. They will not buy all your 50 shares that time. They will buy maybe 5 or 10 shares, right? But over time, your proportion is maintained.
Okay.
That is what a small case is. Now they have extended that concept of buying only shares. You can now buy ETFs. You can buy mutual funds. You can buy products from professional advisors like Capital Mind, right? And many other advisors are there on small case. So instead of you deciding what shares you should buy, how to buy, where to buy, you can now use the professional services. Whether it is a mutual fund, whether it is an asset management company, whether it is a portfolio management service, whether it is a fund advisory, right? Whether it is a trading, they advise you.
Okay, yes, this is my insight about the small case, because many of us are not aware about that, means so how the small case works around. So this is a nice insight. Some of the things that I wanted to ask, means one thing that I have realized after the COVID and looking the people around us, we normally talk about the insurance. Okay, after me, the insurance is there to take care of family. But this problem is a little bit more prolonged, because what happens is that okay, we are too much shy to talk about our finances. That let's say okay, our family members are not aware about that. Means in my case also, I can say that my family will not be aware about that, how many demand accounts I am having, or how many saving accounts I am having, or what is my EPFO number, or certain very, very important credentials, we can say. So what I can do right now, apart from my insurance, so they have the information down the line once I am not around them.
Exactly. Very, very good question. Extremely essential. And if you remember the pyramid I spoke of, estate planning, succession planning, and wills, right? My suggested solution is to discuss with family, right? That is my suggested solution. Unfortunately, many people don't want to do it. Fine, that's each person's choice. My case, I want to do it. My family doesn't want to do it. right? My spouse, my siblings, my brother Kiran, he's fine doing it with. But everyone else, nobody wants to discuss it. Why? Because nobody wants to talk of death, right?
Yeah.
And the fact that I'm talking of after me means I'm talking of me being dead. That's the word. Not everyone's comfortable, and that's their choice. My family is not comfortable, right? So I discuss with Kiran so that Kiran can handle things in my absence.
Okay.
I'm fortunate to have somebody whom I can discuss it with. Most of us are not. So what's the solution? Have a will, preferably drafted by a lawyer. Again, I always say have your professional advisors, be willing to pay them upfront because the value they provide is long lasting. Rather than me paying, back, piche se I'm paying the commission or costs or fees, I prefer to pay upfront. Have an advisor who's my advisor. So get a good lawyer, pay them upfront to prepare your will one time, right? And then keep updating the will on your own.
Okay.
All right. The second part, which you said, nobody knows where what is. Again, we are all in that situation because it keeps changing. We keep adding, we keep dropping things. What solution I do? I do not include these in my will. I mention that in my appendix to the will or annexure to the will, all these are mentioned, right? And using something called as a codicil, I keep updating that annexure oblique appendix. So my will stays the same. The details of my accounts keep changing, right? So as an insurance policy matures, I'll remove it from the updated list, right? Or I'll put it in the list saying this is expired or this is matured, right? As I move out of mutual fund portfolios or I move out of shares or I open and close Demat account. So I keep updating that annexure to my will, right? So my will is generally static. I change it on life circumstances like birth, deaths, marriage, those sort of things. The annexure or the appendix keeps getting updated on a yearly or 2 yearly. I would like to, but frankly, I do it on a 3-4 yearly basis.
Okay.
Right? Get a lawyer, but please. The amount you pay them one time will help you all your life, will help your heirs after we are gone.
Yes. Not at this point. There is one question that we have asked before the session has started. So many of the participants have shared their questions. So one lady has given that question that how working women as well as a housewife can manage their finances.
A very important topic, and I unfortunately keep telling this to all my cousins, right? All my cousin sisters, all my female colleagues. Though they don't want to hear it, I keep telling them. First, be financially independent. If you get married, when you get married, or you don't get married, or you become single, have your finances in your name throughout. Do not put them in your parents' name. Do not put it in your husband's name. Do not put it in your children's name, right? Do not put it in your in-laws' name. Put it in your name. This is what I advise my wife. This is what we do. My wife's investments are all in her name. She has no clue what's going on, but everything is in her name. I advise this to all my cousin sisters, all my female colleagues, though they don't want to hear it. And I tell them, this is not something I should be telling you, but I'm anyway going to tell you. Keep your finances in your name first. Second, awareness. Read, study. If you are not aware, you will not be able to manage your own finances.
Yes.
Right? Third, if you are not able to understand or manage, perfectly fine. Most of us are in that situation. I was in that situation for 14 years of my professional life. It's only in the last 1/3 of my professional life I've actually learned, picked up, and started teaching people. Use a financial planner for this, right?
Okay.
I earlier used to help people do all this, but due to paucity of time, due to personal and professional commitments, I'm not able to. But there are a lot of people who are doing their groups on Facebook. So one I would recommend is Asan Ideas for Wealth. All right. Second is Free FinCal is there by Professor Pattu. Forgetting his Patabi Raman.
Okay.
Professor Patabi Raman, everyone calls him Pattu. There is Solanki on Asan Ideas for Wealth. Your problem is not going to be guidance and advice. Your problem is going to be how to see whom you want to take it from. Right? The sources are far too many. The genuineness is something you have to see. Right? With the explosion of information, everything is available. Like in my, I mentioned a few sites and all. These are ones I actually use. There is Mr. Money Mustache, funny name, excellent resource. He hammers on only on your financial independence, right? There is a movement called financial independence, retire early. I'm not too focused on the retire early, but I am very focused on the financial independence. Use these resources. There is JL Collins has got a beautiful stock series, which is there's a whole bestseller book written on that. Right, Simple Path to Wealth. But that full thing, instead of buying the book, he's given it on his blog. Go read for free. I've given the link. Right, and a very good question. Please plan for your savings. Nobody knows what is going to happen down the line when we lose our spouses, if we separate from our spouses. Plan for your independence, plan for your joint independence.
Yes. Okay. The next thing is that what happens to the old age people? That means those who has worked so hard in their earlier years, and let's say they are the government employees, and they retire right now, and they get some corpus, means because earlier it used to happen, that means they used to have the pension from the government, and their corpus is also getting built by the government, so they never think of about the retirement planning because government has taken a charge of that. But let's say once they have retired, they get in a corpus like 50 lakh or 70 lakh at a one go. So after receiving such a huge corpus, how should they manage? Let's say the senior citizen person within such kind of a huge corpus, how should they go about this huge corpus?
I'll split that answer into two parts. One, for the people who have handled their finances and investments before retiring. Second, for those who haven't handled. Right. So if a person has never handled their finances, left it on auto mode and just chal raha types. Simple answer: contact a financial advisor at the outset to invest your corpus, and then start learning to handle your own finances. If you have already been managing and handling your own finances, follow the process which I've laid out in very brief. Because I've not been able to cover, like I said, I cover this in generally 6 hours, which is 4 sessions of what we had today. So if I can in future cover, they can use this process end to end. They can develop their own investment framework, develop their own financial plan, and use that to manage their finances, which is what I will be doing for myself, or rather I am doing for myself, and I'm advising people to do it. Right? I prefer not to spend time advising people on what to do. I prefer spending time on people how to do, rather than giving them a fish. I try to help them, teach them fishing.
How to do fishing.
Right. So I generally nowadays turn down requests for planning for them, but I'm more than happy to take things like today's call where you asked me, Kapil, to teach how to do it.
That is a great approach. One more thing that concerns to normally of us is that how I can have the means what are the quick indicators which gives me that whether I'm financially secure or somewhat I'm lacking somewhere.
Okay, the best way would be to have your financial plan knowing where you are, where you want to be. The other way is the rule of thumb. Right, there are a lot of resources online which will tell you if you have worked this many years. Okay, I can mention one which, because I use it myself. There's a blog called financialsamurai.com, right? Financialsamurai.com. He has an excellent resource where he says if you have worked this many years, you should have saved this much percent in terms of your current income. So you can use those resources. Best way, have your financial plan, know where you are, know where you want to be. Otherwise, use heuristics, use thumb of rules. Like I mentioned, Financial Samurai, there's also Mad Find right? Use DuckDuckGo, use Google. If you're not concerned about privacy, Google. Otherwise, use DuckDuckGo. Everything is available online.
Okay, fine. So what we think is that we have a certain kind of community platform on a Discord. So whether on this Discord, still now we were talking about the stocks, charts, and the mutual fund related things over there. But now, after getting you on the board, means after having the learning from your side and after having some sort of resources, we are trying to create another room for the personal finance. So where we are planning to think that means whatever the sources that you have referred, so we will look into it this, and whatever in a very piecemeal way we try to share certain kind of information to our participants as well. So for that purpose, we have created a room on the Discord. So the participant will request that okay, you can join that particular Discord channel. So we can be, means whatever the Rakesh has suggested, some sort of sources. So we can work on that and we can share a certain kind of information from that as well.
That's a good initiative, Kapil, and I'm sure it will help everyone.
Yes, of course.
I think there are a couple of more questions that come in. Biju has asked, in
Biju,
investing on wealth basket, mutual fund, small case, or ETF, which one should be better? I would say there is no better or worse. It is what is your level of awareness, how much time you can give, and what are your requirements, right? For most people, mutual funds using a SIP mode is the best option, right? If you're slightly more aware, you can then use small cases. And if you have got more time, you are more hands-on, you can then use ETFs, right? Moving on from ETFs, you can also use direct equity and individual shares. So it's each person's individual circumstance, time, requirements, and awareness. Yatharth, I'm not aware of the institutes which offer CFA or CFP. If you connect with me on LinkedIn, I can put you in touch with the person or people who will actually are CFAs, CFPs, and who can answer this, right? There are people I know, they do not do it on a formal basis, but they can put you in touch. Either they can help you out or they can put you in touch with formal institutes, right?
Yes. Any participants means our conversation is going on with the Rakeshi. I am having some more questions to ask from the means to seek the answer from Rakeshi. And meanwhile, if you have any kind of questions, please put up. So Amit will take a note of this and he will direct you or he will give you the audio right, so you can directly have your question to the Rakeshi. Fine. Yes. One more thing that I normally think about the personal finance means when we say that okay, you need to go for a personal finance kind of things or the financial planner. So the one thing that we normally feel like it is in kind of the high end thing. That means the person who is very established, who is having a good amount of the money with him. So they are only in the need of the financial planner or need a service of financial planner. So is there any kind of thing that can, let's say the person who is starting his career let's say he's getting earned like a 25,000 per month in his age of 20 to 25. So what kind of things he need to do by his own?
Right. So Kapil, what you said about it being a high end or a niche thing, yes, it used to be initially. Now it is becoming more and more mainstream. So which is why I specifically see there are a lot of different types of advisors, investors, management and all. I only mentioned the registered investment advisors, right? Now, how you deal with the registered investment advisor depends on you and the advisor. Some take the fees as a percentage of the funds. Some take it as a fixed amount, right? So now again, it depends on which stage of life you're in. If you're a new employee, you have the time to learn all this on your own. You don't need anyone to do it for you. You don't need if you're 22, 20, 21, 25, you have decades to learn, implement, make mistakes, recover, and still do well. You don't need a financial planner. You don't need an advisor. Learn it on your own. If you're smart enough to get a job, you're smart enough to learn this. It's not rocket science. It's not nuclear engineering. It is not an engineering, right? It's not finances. It's not economics. It's a very simple thing. It is what you require. Nobody else can answer it better than you can. So learn it. If you're mid-stage, you don't have the time, you don't have the inclination, you don't have the interest, you don't have a choice. You have to then either go to a financial planner or just trial and error what is available in the market. If one is nearing retirement, already retired, please go to a financial advisor, irrespective of the cost. Okay. Right? So depending on life stage, you have to see. But just remember, everyone in financial planning, there's no one size fits all. Right? What suits me doesn't even suit my wife.
Yes, Amit. Sitaramji wants to ask questions.
Yeah, hi Sitaram, please. Okay. Sitaram, you'll have to unmute yourself.
I just asked him to unmute. Okay. So means Sitaram was the first one for the answer, but anyhow we are not able to take in this question. So, Sitaram, you can speak or you can type in, so also we can understand and we can revert on that front.
Yeah, please use a Q&A to ask a question, or you can use a chat. Either way, we're looking at both.
Yes. We are having certain kind of questions from Yatharji. Means by looking at the Yatharji's questions, I am raising one more question. Is that means as the question seems like means they are very in an earlier part of their career or professional career, we can say. So, any kind of the tips that you wanted to share for a teenager to handle their finances?
Rather than for teenagers, I would first tell parents, start teaching your kids once they are about 6.
Okay.
There's an excellent series of books produced by one of the Zerodha employees, Ranganathan. It's called as Rupee Tales. You can use those book, right? Start giving your kids allowances, pay them for doing work around the house. Do not give them whatever they want. Let them buy it with their own allowance, right? Whenever you're using things like credit card, debit card, ATMs, explain that those are not money trees, right? That's actually your money which you're spending. They need to see that we as parents are ourselves being disciplined with our finances. That is how they will learn. If I'm paying my credit card bills 2 months late, I'm buying anything and everything I want, they are going to learn that. Now, when they become teenagers, you need to give them a monthly allowance and let them manage their finances, their expenses. And they need to realize that they can't have everything. If I want to do A, B, C, but the allowance is only adequate for A and B, I need to choose. If I want to do C also, either earn an income doing things on your own or doing things around the house, right? Which I would be paying somebody else. Tough love, right? Don't pamper them. All right. When they're starting work, encourage them. We don't know what are the best avenues available if we are ourselves not aware. So either become self-aware or guide them, buy them the books, teach them, guide them to the resources where they can learn to manage their own finances, right? Do not let them get into the investment income minus expenses saving. Guide them, route them towards the investment minus savings is expenses. Get them into that mindset. I wish somebody had told me this 20 odd years back. Better late than never, but the earlier the better, because you can get the benefit of compounding.
Yes.
Investing in something is better than not investing. Investing in a fixed deposit with all its drawbacks is way better than not investing in anything at all.
Yes. So it is actually the very new term that I have seen, the tough love. And it is very essential that otherwise we keep on giving them the free hands, and that means we are at a fault if we are not teaching them about the value of money and how to channelize in a proper way. So as a parent, we need to take care of that.
Yes, and I can say I'm not a very popular gifter because I generally tend to give people either mutual funds or things like that, or books.
Yes. Okay. The next thing that I wanted to ask is that let's say in our I am from the trading background, so I understand that there are some sorts of the golden rules for the trading. There is no second thought on that. Let's say you have to follow the stop losses, you have to have your prior analysis.
Kapil, I just need to cut you off because this question by Sitaraman is actually I need to answer.
Okay.
Because he seems to have got a wrong impression. Sorry for that. Sitaraman, what I was showing you is the difference. It is not the long-term investment in equities is 5.7%. What I was trying to show you is when somebody is trying to sell you, I can give you two different pictures of the same thing over the same time period, right? If I want to sell equities to you, I could have shown you that 22.7% or whatever, 27% or whatever is the 1 year return. If I don't want to sell you equities, I would have shown you the 5.7%. The point is that everything depends on the time horizon I'm taking, on the asset I'm taking, right? So you have got the wrong impression from that question. What you have got the impression is totally wrong. I hope that answered you. Sorry, Kapil, you were saying.
Yes. There is one question from Praveen ji. Yes, this is how to find a genuine. Okay, Praveen ji, Amit, can you give the audio right to Praveen ji so they can directly address that question to Rakesh?
Yes, Kapil. Yes, Kapil. Yes, Mr.
Hello.
Praveen.
Yeah.
Yeah, I just wanted to check, like, because we are discussing like the financial planner will give an advice which may be good for him, not for the customer. So how to find a person who's giving an advice that is a genuine advice? Well, he's a genuine financial planner, not the one,
You
like.
have to find
So
a
how to find out that thing?
registered investment advisor, RIA,
Yeah.
CBRIA, registered investment advisor. So one resource is freefincal.com. On that website, they have a list of these advisors. They have also advised the Independent Financial Advisors Association of India or something to that effect. They only admit financial planners who will work for their clients or their customers' benefit, who do not sell products, right? So Free FinCal and their list, plus Professor Pattu and others have formed this Independent Financial Advisors India Association. Find it through them. LinkedIn, there is also a group called Financial Network of Financial Planners. You can go there, right? You can check resources like Wealth, Economic Times Wealth, which is a supplement which comes every Monday. Outlook Money, right? Then there is other magazines also. Business Today also has a BT Money. These all focus on finance and personal finance. You can write to them. They have on their panel. You can find through them. SEBI also has the list of registered advisors, so you can find through those. That's why I said Google is your friend.
Yeah, yeah. My question was, I will not mind paying upfront
Your
fees to the
question is
financial advisor.
how you find. This is how you will find.
Yeah, yeah, yeah. Yeah, thank you very much.
Right, and you also asked about mutual fund ratings. I don't look at ratings. I cannot speak about them because ratings I find are not good enough. Right, I would go the top-down approach, analyze your requirements, find your solutions.
Yeah, sometimes I've seen the ratings across, like if you go to moneycontrol.com or to
Go to money,
valueresearch.com.
value
So
research.
they're almost same. They're almost same.
Yeah. So see, I've invested in funds which have a 2-star rating, right? And I've been very happy with it. What do you say to that then? So that is why I said find your requirements and then the appropriate solutions.
Yeah. Okay. Thank you.
Yes. Rakesh, I just try to continue from where I have left earlier. So let's say, I mean, I'm from a trading background. So in a trading background, I can say that there are certain kinds of golden rules are there, which doesn't have the second thought. Like means trading within stop losses, trading means knowing your risk appetite, understanding that how much quantity that you can buy and efforts kinds of things. So in a personal finance segment, any golden rules that you find which one should be aware of?
Yeah, so I actually structured it in a similar way itself. First, have an emergency fund, thumb rule, 3 to 12 months minimum. Second thumb rule, get insurance, right? Third thumb rule is that formula, income minus savings equals to expenses. See, nothing I've created new. These are all standard knowledge, right? So fourth one, try to save 20% of your income post-tax, ideally 50% of income post-tax. Fifth thumb rule, invest regularly with discipline. Whether you're investing 5 rupees a month or much larger amounts, invest every month, every time, continue investing. Right. Sixth one, have a plan, stick to your plan and your asset allocation. I would say these 6 things, if you do progressively, if you do the first 3 itself, you're ahead of 90% of people. You do the first 6, you are, all these 6, you are on the top 1%.
Okay. So fine. So that was the process that we have to follow as our golden rule. Yes, it was a very step-by-step kinds of things. The emergency fund, insurance, then the equations. Yes, got it.
So Sitaraman has asked, could you please confirm that in the long term, nothing to beat equity investment? As far as return is concerned, I would put a disclaimer to that. Equity over long term gives you the highest return, but nothing beats asset allocation and portfolio rebalancing. So I will not specify a asset class, because what beats equity and what beats anything is asset allocate a financial plan which has a structured asset allocation and portfolio rebalancing to back up these two. So not an asset class, it's a plan which beats everything.
Okay. Yes, we are moving towards the end of the session. Before I end the sessions, in a start, you have said about the two platforms that you are using for your personal finance, like in the Walnuts and Perfios. So, are those called as in a neo banking?
Okay, so neo banking is something which is basically a bank, but it's a digital bank. It does not have a physical presence. So what I am using currently is something called as a mutual fund utilities.
Mm-hmm.
I just put it in the chat for everyone. The other thing which is now coming up is mutual fund central. They will allow you to do everything related to all mutual funds from these two platforms.
Mm-hmm.
Currently, mutual fund utilities is matured. It's fully functional. You can use that and see how MF Central comes. Now, what do you mean by neobank? Neobanks are basically banks which only have a digital presence. They do not have a physical branches, right? All your old banks also slowly having incorporating these features. But these banks are purely digital. They use technology, artificial intelligence to give you personalized, meet your requirements personalized. Right? There are a few Razorpay X, Neo, Open, Instant Pay. Many of them are coming. If they meet your requirements, yes, you can consider using them. But a lot of the banks, like especially the private banks, they give you a lot of these features along with being the traditional banking. So your choice which suits you.
Rakesh, during the discussions, you have shared lots of resources to refer. Means some of the points that I was able to mention down, but many of the points I was not able to cover it up. In your one of the presentation, you have shared all the details. That means the resources link that you have. Apart from that, if anything that you have, we request you to share to me in a person so I can share with the participants, or you can put on the, if you are the part of the Discord channel, so in a personal finance section, you can put up the resources so we can actually widen it out. These are the certain kind of resources that one can refer.
Right, but primarily the ones I use for reference are there. What I actually use for you implementing things and all, I didn't put because I haven't covered those aspects in the talk today.
Yes. So we look forward. That means those names, so I can share with the with our widened community. Fine?
I'll do that.
Okay. So these are the certain kind of questions from my end. Let me see if any questions that I left up with. I think that means much of the questions that I have covered up. And many of the questions that I have listed down earlier. So you have already covered while taking the sessions and answering the other participants. So yes, to a community, to the participants, if any questions that you left with, do let us know that how to handle that. Yes, Saraj ji has one question: how to come of FOMO in fear? Means basically nowadays it is a very common. That means when we look at the Twitter and we look at some sorts of social pages, so everyone comes up with their images. That means this is amount of money that they have made, and it gives us a kind of tempting. So and it pushes the financial planning at the back end. Okay, what is my risk appetite? What is my goal? And we try to chase those kinds of things.
Absolutely.
So one question from Saraj is very apt. How to overcome the FOMO in fear?
Firstly, you're never going to get rid of FOMO in fear. I've been investing for 17 years. I still have FOMO in fear daily. Right? So on a group which Kapil and I are part of, you'll have people putting fabulous returns, and then I'm like, oh shit, people are doing that. Right? And then you'll have people are, fear is also accompanying that. Greed and fear have come together. Right. So, but how do you deal with it? There are only two ways of dealing with it: have a plan and have the discipline to stick to your plan. Right. Feel the fear, feel the greed, and then do what needs to be done. There is no other way. For which you need to have a plan to do. If you don't have a plan, you don't know what to do. So your plan could be as simple as I'm going to only invest in FD. That is also a financial plan, but have a plan.
Okay. Fine, Rakesh ji. So much of the question that is answered from my side as well. Many of the participants has also their questions. We have replied to almost each and every one, and we know about your time schedule. That means you means it is very difficult for you to take out the 2 hours for this kind of activity. We are so much thankful for this. You have your 2 hours, and in future, based on the further reviews and further curiosities about the different topics, because you have compressed the 6 hours into the just 1 and 15 minutes kinds of things. So in the future, we will like to reapproach you to give the detailed insights on some of the topics that we have just passed on, or we need to do a little bit more detailing on that.
Sure, Kapil. And what I'll also do, I'll share this deck with you so they can give it to the wider audience and they can go through it, because my apologies to everyone for rushing through things, given the paucity of time, but please take your time and go through this in your own time.
Yes. Okay, fine, Rakesh. So on this note, we end the sessions, and we are from a Finland Academy, from the participant perspective, we are too much thankful to you for your insights and that in a very decent way that you have given us. Thank you so much. And thank you so much, participants.
Thank you. Thank you.